What if I told you the interest rates you see in the news are on just economic tools, but warning signals? What if those signals are no longer aligned? For over a decade, the world's central banks moved like a synchronized machine, cutting rates together, printing money together, stabilizing markets together. That era is over. Now they are pulling in opposite directions. The U.S. Federal Reserve hints at future cuts. The Bank of England is politically trapped, and the Bank of Japan is quietly preparing to raise rates for the first time in a generation. This isn't coordination. This is fracture. The machine that once moved in harmony is now grinding against itself, and we are all standing directly on the fault line. The real question is no longer when rates will change. It's why the global system can no longer agree on what survival even looks like. To understand what's happening now, you have to understand what interest rates really are. They are not just numbers on a screen. They are the price of money itself. They decide whether debt explodes or contracts. They determine whether governments can survive their own obligations. They dictate whether your savings grow or silently decay. Central banks are the only institutions with the authority to set this price, making them the quiet architects of the modern economy. They don't just respond to markets. They actively shape behavior, risk, and survival. When rates fall, borrowing surges and speculation expands. When rates rise, debt suffocates and economies slow. For decades, these institutions acted in near-perfect coordination. That coordination created predictability. Predictability became the greatest illusion of stability the global system has ever known. This system of control did not emerge naturally. It was born from collapse. When the gold standard was abandoned, money lost its physical anchor. Central banks stepped into that vacuum as the new guardians of value. Instead of being constrained by gold, national economies became constrained only by policy decisions. This shift turned central bankers into economic engineers. They introduced forward guidance, a new language of promises and signals meant to steer behavior before reality ever arrived. Markets became addicted to these signals. Expectations stopped reacting to the economy. The economy started reacting to expectations. This feedback loop gave central banks unprecedented influence, but also planted the seeds of today's instability. The peak of this coordinated control came after the 2008 financial crisis. To stop a complete systemic collapse, central banks launched the most extreme monetary experiment in human history. Interest rates were pushed to zero. In some countries, even below zero. Trillions of dollars were created digitally and injected into the financial system. This was not gradual. It was explosive. Between 2008 and 2020, global debt more than doubled. Climbing above 300% of world GDP, that means the world owed 3 times more than it produced in an entire year. Cheap money created a decade-long asset. Boom. Stocks soared. Housing exploded. Speculation became survival. It felt like permanent growth. But it was an illusion built on compounding leverage. Debt stopped being a tool, became the foundation. Governments borrowed without restraint. Corporations loaded their balance sheets with cheap credit. Consumers financed lifestyles with loans instead of wages. This worked only as long as interest rates stayed near zero. The moment they rose, the entire structure would be exposed. But for years, central banks insisted inflation was dead. The belief became doctrine, and doctrine bred complacency. Then the illusion shattered. After the pandemic, supply chains broke, money creation surged, and demand snapped back violently. Inflation returned with a vengeance. In the United States, consumer prices rose at the fastest pace in over 40 years. Energy, food, rent, transportation, nothing was spared. Central banks had no choice but to reverse course. Rates began rising at speeds never seen in modern monetary history. But this created a new and far more dangerous problem. The system was no longer built to survive higher rates. Global debt had grown too large. Governments that once paid almost nothing now faced spiraling interest expenses. Corporations that relied on rollover financing suddenly faced extinction. Central banks were caught in a trap. Raise rates and risk collapse. Keep them low and let inflation devour the currency. That brings us to the present moment, where coordination has collapsed into divergence. The U.S. Federal Reserve, after one of the most aggressive rate hiking cycles ever recorded, is now signaling caution. Markets are already betting on future cuts. The CME FedWatch tool currently prices an 87% probability of a U.S. rate cut by December 2025. That is not speculation. That is market consensus. It means investors believe the economy cannot withstand higher rates for much longer without breaking something fundamental. Meanwhile, the Bank of England is stuck in a political and economic trap. Inflation remains stubborn, growth remains weak. A recent vote to hold rates was narrowly divided, revealing deep internal disagreement. Analysts are already predicting that Britain's base rate could fall toward 3.75% by year-end if recessionary pressure deepens. The British economy is squeezed between debt reliance and inflation fear, with no clean exit. And then there is the Bank of Japan. For decades, Japan was the extreme outlier. Its interest rates sat at 0 or below for nearly an entire generation. This created the largest carry trade in the world. Trillions of dollars were borrowed cheaply in yen and invested elsewhere for higher returns. Japanese policy became the invisible foundation of global speculation. Now that foundation is cracking, Bank of Japan is signaling its first meaningful rate hike in decades. This is not a technical adjustment, it is a tectonic shift. If Japanese rates rise, global carry trades unwind. Capital rushes backward, bond markets destabilize, currencies swing violently. Emerging markets feel the shock first. What once flowed outward now snaps inward. This is why global bond volatility exploded the moment Japan hinted at tightening. This is not a normal policy decision. It is a threat to the plumbing of the entire financial system. This divergence is no small disagreement. It creates chaos in capital flows. Money now chases yield across borders at digital speed. Currencies surge and collapse on central bank whispers. Governments lose control of borrowing costs overnight. The global system is no longer synchronized. It is fragmented, and fragmentation is far more dangerous than coordination ever was. So who benefits and who pays? Rate cuts? Rescue debtors? They keep governments solvent. They preserve corporate balance sheets. They inflate asset values. But they punish savers through silent theft. Inflation erodes purchasing power. Workers find their wages shrinking in real terms. Housing becomes permanently unaffordable. The wealthy benefit from asset inflation. Everyone else falls behind. Rate hikes, on the other hand, reward savers and stabilize currencies, but they crush borrowers. Mortgage payments explode. Businesses fail. Governments flirt with fiscal crises. Pension systems wobble as bond values swing violently. Volatility does not destroy wealth. It transfers it, quietly, relentlessly, from those who need stability to those who thrive on turbulence. Central banks promise soft landings. History rarely delivers them. Economic tightening almost always breaks something important. They now face a dilemma with no clean solution. High rates make the global debt burden mathematically unsustainable. Low rates guarantee future inflation and larger bubbles. Every policy choice now creates a bigger problem later. The tools that once stabilized the system now destabilize it. The cures have become part of the disease. This pattern is not new. Markets have always front-run central banks. But now speed has reached a level never seen before. Trillions of dollars reprice themselves based on sentence fragments in press conferences. Algorithms respond before humans finish listening. Expectations move faster than reality. Confidence now drives the economy more than production. This is the ultimate fragility. When value rests on belief rather than output, control becomes psychological. And psychology breaks faster than systems ever do. Take away these three truths. The global economy is not merely fueled by debt, it is structurally dependent on it. Central banks do not command the system as completely as they claim. They react to forces their own policies created, and the consequences of policy failure do not fall equally. They fall on savers, workers, and future generations first, while the upside is captured by those positioned closest to the flow of capital. We are now approaching a moment without historical precedent. For the first time in over a decade, the world's most powerful central banks are no longer aligned. The danger is no longer synchronized collapse. It is uncontrolled divergence. The machine is no longer moving together. Its gears are pulling against one another at full force. And here is the darkest truth. The system only looks stable when everyone moves together. When they split, pressure does not release gradually. It snaps. The next crisis may not begin in stocks or housing. It may begin in currency markets, in bond plumbing, in the invisible infrastructure that holds the system together. And when that breaks, rescue will not be as unified as before. These rate signals are not theoretical. They're flashing right now, quietly, relentlessly. If the architects of global finance no longer agree on the blueprint, then the structure itself is already at risk. What follows is not a single crash. It is a series of controlled failures designed to keep everything standing just long enough to transfer what remains. If you want to understand the forces that will define the next decade, now is the time to pay attention. Subscribe for deeper breakdowns of the hidden mechanics shaping the global economy. Because when this fracture finally gives way, the narrative will claim it was unpredictable. But the warning signs are already everywhere.